Martin, thank you so much for doing this and just chatting to our entrepreneurs who are building products and brands and just really talk around finance. I know you've been in FMCG and you've built your own business. You are fractional CFO. What is a fractional CFO?
Fractional CFO. All they do, in a nutshell, is to offer financial advice to corporates, to small businesses on a fractional basis. So we sell time.
Okay.
And that it could be a retainer, it could be an hourly charge. But all we're doing here is we're not on your payroll full time.
Yeah.
You're like subcontracting us for a small fee.
Yeah.
And that's what we do in a nutshell. But we offer financial advice.
Okay. So how long do you spend in a company? Is it like once a week, like an hour a week, or generally, especially for a small business?
That's a good question. For small businesses, my experience has been that it depends. Again, there are those who want a retainer, so you agree on the number of hours you work in a particular month. I've had a situation where I work only 12 hours at a given hourly rate.
Okay.
Then there's some, but mostly it's driven by the hours.
Okay.
Right?
Okay.
There's some who agree. I've just had a recent client who gave me a retainer where he said, he'll pay you 10,000. Whether I use you or not, I'll pay you 10,000.
Yeah.
But when the work does kick in, so it's like a more hybrid model. When the work kicks in, then you'll start charging him per hour at a given rate.
Okay. So Martin, like I mean, having built a business in FMCG, often, I've always just focused, before I knew, I've always just focused on, get the recipe right, get the product right, get the packaging, let it look pretty, let it be functional, and let it sit on, be able to sit in the store. And then sometimes only later do I realize, actually, this product is not profitable. Yeah. And sometimes it's like a year after, you're like, actually, we've been selling this at a loss. It's like, where do we get it wrong as entrepreneurs who are building brands?
That's a good question. So my experience has been that entrepreneurs focus a lot on the top line and maybe the trade listing and discounts, and that's where
top line. What's top line?
Top line is revenue.
Okay.
Money's coming in, what's in the bank.
Yeah.
That's it. Forget about it. But in between, there's a myriad of costs involved. And so it's important before you list a product, you get a true understanding of the cost structure, because that's where money is made or lost.
Sure.
So for instance, you talk about being unprofitable. Have you taken time to understand the cost structure? What's involved in producing this product? Let's assume you're producing it or manufacturing it. There's so many costs involved to get that product onto the shelf. Or if you are sourcing it, a finished good, you're importing it. Yeah. To get to the landed cost being that cost that brings the physical good to its current location. Yeah. There are so many costs. So if you don't understand that cost structure, how do you price right?
So what are some of the costs that we would think about?
All right.
So let's take an example. Let's say I am importing, we can make two scenarios. So I'm manufacturing, but I'm also importing. So let's say I'm importing hair clippers, or nail polish. Yeah. I'm importing it from, say for example, I'm bringing it in from Kenya and I'm bringing it into South Africa. Yeah. Like walk me through, what are some of the costs that could be there?
So you need first of all understand the tax regime between the two countries, right? There's so many taxes involved to bring a commodity from Kenya onto the shores of Durban or South Africa. Yeah. So you have to go back, speak to the authorities, understand those costs. There's a lot of insurance costs, the freight costs. So you have to have these discussions with the freight forwarders. Yeah. Have that true understanding. Because remember, there's also other intricacies whereby it depends on the agreement.
Yeah.
Where you have, you can have a door-to-door arrangement, right? Get the full understanding of the costs involved, where the person, will he deliver that product? I'll give you an example.
Yeah.
Nike, you can order here from your screen or your laptop to in Netherlands. The pair of shoes will arrive to your doorstep, but you have incurred all the costs. You don't even have to worry about it because the product gets to you right? But if you were then going to sell it on, it's important to understand that entire value chain and the costs related. So to answer your question, sit with the freight forwarders, sit with the main supplier. Agree. Are you delivering it? Do I have to pick up the goods, ex-wax, from your location?
Yeah.
In which case I have to incur all these costs. Or I'll pick them up from the port of Durban. Agree on the cost structure. So get an understanding of all that, and that's on imported goods. Then that's when you get the true landed cost.
Okay.
Manufacturing is a different ballgame altogether.
Yeah.
Manufacturing, there's so many costs involved. For instance, you have, let's go back to let's not talk about the goods on the shelf. Let's talk about the goods, the pricing within the company before it even gets to the shelf. Because that's not something for you to worry about right now. So you are a small business, you want to produce, let's say, let me use jig as an example. Now, to arrive at that price, there's a lot involved behind the scenes. One, you have to understand what we call the cost of goods sold, which is a composition of your direct materials, right? We know what the direct materials are. Those are usually your raw materials. But you also have the packaging, that bottle, the cup. Then you have the labor, direct labor, those guys who are going to work on the products, on the lines, correct? Then you have the manufacturing overheads that pertain to just the factory alone, right? That's just one component. Then there's that other component which I call cost to serve, where you have warehousing, logistics,
Sales team,
sales commissions, that you also have to capture. Then there's the fixed overheads of the head office. That is also a cost neglected by many. It's important you capture that too, because there's a share of finance, accounting, legal, all those contribute to your to the end product, whether you like it or not. They do, because the legal people will work on the legal frameworks that pertain to the product. The finance people do the reporting to capture the margins and the performance of that very product. The sales people, as we discussed, that marketing, involved in branding and.
But I know in a small business, generally the founder would be either one founder. If there's two founders, they will be probably doing all of that, and they might have a small little warehouse somewhere, and they're paying rent and that cost. So their salaries is actually a sort of head office cost, right?
Yes.
Because maybe they're not producing the product. Maybe they might have one a production assistant who's actually on the floor doing the packaging or mixing, blending, and then and packaging it in.
Absolutely. So the main point here is make sure you capture all the costs involved in producing that product. Once you capture that, you understand the unit economics, then it can inform your pricing decision. Then you're likely to get your pricing right.
So where do people make mistakes? I think around
stop
costing.
on the my experience, they stop on just on the variable costs, labor, this and that, materials, and that's where they stop. And also if you're fortunate, they may even capture some trade listings, right? If they have to list the product, promotions, but at times they miss out on all that. They get excited about the launching of the product without understanding the mechanics behind the real product. Secondly, SMEs, founders do not take time or invest time in understanding the financial aspect of the business. Because once you devote yourself to understanding that thing called finance, you're likely to make better informed decisions.
What should they do? So for example, if I'm making a relish or a chili sauce, right? And maybe I'm a chef and I decide I'm going to make this product. I've never been trained in accounting. I don't know what to look for. I don't know how to price. I don't know how to track. What should I do every day? And what should I do on a weekly basis? What is expected of me on a monthly basis, quarterly and annually? Maybe just take me through.
So, thanks for the question. So, if you look at it, Spamanda, for starters, in today's world, I think ignorance is not acceptable, given that we have AI at our fingertips, we have computers, laptops, phones and all that. We should find time to understand the finance aspect. But let's say, because even if you came to me and sought my services, I would give you advice, but you will not appreciate it that much. And that has been my experience.
Yeah.
Where the CEOs lack the financial knowledge. And even if you give them advice, cash forecasting, all these the pricing models, they become their back burners. They never go back and really visit it. They only come through when there's a cash crisis. So my point is that take time to educate yourself.
Yeah.
But to answer your question, you're a CEO, you have no financial knowledge. But let's assume now you've taken time to, let's say, solicit services, let's say, for me, who's a fractional CFO, at a small fee, right? The first things we'll do is, first of all, I'll walk around, do a due diligence of your business, understand your business. But over and above that, we need to agree that you and I will walk this journey together, right? So we break down, I usually go back to, I'll ask you questions about how you derive the pricing, and we work backwards. I have what we call a fully loaded cost model. All it does is to capture all the costs. So you and I will walk through the cost. So you made this chili. What did you go through? This and this and this and that and that. Okay. You missed out on this, you missed out on that, you missed out on that. Oh, you captured it well, that this price. So you're like going back and peeling the onion to get a full understanding of how the price was arrived at. So you're going back to first principles. Once you're happy with that, I always argue that once you've done your cost structuring and you're accurate with that, what's your target margin? What margin would you want on this product? Ignoring what the competitor is doing.
Yeah.
Let's assume everything was honky-dory, there's no competitor. What has been your sweat? What have you gone through? What margin would you want out of this product?
Because that's important. Hey? Usually we always look at what the competitor is charging. It's like, okay, no, I'm going to just charge them R5 less than the competitor.
Yeah.
And then that's not actually wise,
No.
because then we don't know what they go through.
Exactly.
All right.
So once you're happy with that and my target margin is 40%, my costing is that, I have a price of 100 Rand. You then stress test it against the market.
Yeah.
Right? Of course, it's important that you're stress testing similar products, right? In similar markets and some customer.
Yeah.
Right? Then you can begin to tweak that pricing. Because remember, you do not want to price yourself out of the market, but you also don't want to leave margins on the table. Right? So you have to find
what does that mean, to leave margins on the table?
So you have a cost floor, then you have a market ceiling. In between that is what we call the pricing, right? So you've understood your cost structure, right? You have done your homework, you've had it in your target margin. I want a 40%. I've got the 100 Rand. You'll be comfortable knowing that I have done everything under the sun to capture all my costs. I'm not leaving any revenue. Because all I'm saying, margin is revenue minus your cost to give you your gross profit. To get to margin is just a formula, gross profit over your sales, that gives you that margin. But all you're doing is to tick off that you have captured all the costs, and I'm confident that the margin that I'm going to enjoy going forward is satisfactory. So I've not left any margin on the table.
Okay.
But over and above that, if you go out now and you do your market research, you go out there and begin to test your product and find out that, oops, maybe I'm overly priced compared to the likes of Pick and Pay. Maybe it's best I reduce the price. Again, depending on what your strategy is, Pamandla.
For the market positioning.
Correct.
Yeah.
Because remember, you come in, you want everyone to test your product. Let's say it's a new product. You're introducing a new product. The pricing is going to be different. You can afford to take them. You may be able to take the loss right now because you're trying to penetrate the market. So you may come in at a lower price because you want everyone to get a feel, a testing of your product.
How do I buffer that though? If I'm like, what do I have to have in place?
Yeah.
It means I should raise capital before I start.
Absolutely, you must have some savings. You have to have some degree of buffer, of course. And that's the risk that as business owners you have to take because you're trying to get yourself out there.
Like, and you would be comfortable with say, look, I'm comfortable to take this loss for 3 months as an example. And if it beyond that, then it means it's the product, it's not going to work.
Absolutely. So timing is everything. And of course, yes, you can only take losses for a particular period of time, right? But I think those are the costs of doing business. Those are the risks you take, that, I'm launching a new product. You have to buffer that in, factor it in, that, what, for the first 3 months, I may not see takeoff. But I have some cash reserves that will cushion me for those 3 months. And then when we take off, I can now begin, depending on the feedback I'm getting from the market.
Yeah.
I know that my pricing is bulletproof, my pricing is good, maybe I can increase it, maybe I can drop it. And then you start flooding the market with your products.
Sure.
So it's important to understand, again, your product life cycle. Where are you? Because you notice that in some FMCGs, the established ones, in order to prolong the life cycle of a product, they call it flanking, bring in new goods, new SKUs, all that. But in my previous life as a cost management accountant with these the big multinationals, they were careful that before they launched the product, they did their homework. There's business justification. You have guys going to Nielsen, collecting that data. You build the model from bottoms up, launching this product, and they spend a lot of man hours creating these Excel sheets, and then brought over to the finance people who vet, they check that actually these numbers make sense.
Yeah.
Then they launch the product. But then I was responsible for tracking those products over 3 years. New product development, call them NPDs. You track the margins, the performance over 3 years.
Okay.
And then the business will make a decision whether to cull the product or continue.
Okay, so many questions, but I want to go back. I want to go back to this. So, on a weekly basis, what should I make sure that I'm clear? And then on a monthly basis, what?
As an SME, weekly basis, cash is king, cash is queen, depending what sex you are. So always have your cash report ready. Look at it every week.
Money that's coming in.
Money
that's coming out.
Money in, money out.
Yeah.
Right? That's your cash flow. And understand your cash position at all times.
Okay.
That's weekly.
And if I'm not paid immediately, I also need to still track that to say, okay, how many invoices, who owes us, who do we owe in that week?
I encourage businesses, SMEs, but many struggle keeping this, what we call the cash flow forecast. I think it's a lifesaver. Why? It helps you plan over 6 weeks, 13 weeks. Right? Money coming in this particular week, I can plan to pay this particular client on this particular day. Okay. So you build that relationship with your clients, avoiding that bad reputation that you do not pay your bills.
Sure.
Right? So once you have a cash flow forecast on a weekly basis, I encourage the SMEs to track, the founders, have the cash flow forecast and track it on a weekly basis. Okay. Money coming in from the customers, which obligations do you have to settle, right? What's my new cash position? Looking at my closing balance becomes your opening. Again, you track, right? And that will help you plan. And that will bring me to what we call your operating cash flow, cash conversion cycle.
Take us through, what is that?
So all the operating cash flow conversion is all about is, you asked me a question, I think, when we met, the difference between profit and cash. That difference is your CCC, cash conversion cycle. What's that made up of? So your profit will never equal to cash as long as you have debtors, as long as you have inventory and accounts payables. So, and that's what makes up your cash conversion cycle. So in other words, profit is just an accounting measure, right? Cash is king. If you're not collecting from your customers, that's affects your cash position. And that's why businesses suffer and fail. Inventory days. How much inventory are you carrying? Because that's cash stuck in there. It affects your cash cycle. Remember, you brought in this inventory to sell, or you manufactured it to sell. The fact that it sits there for 60 days, that's cash being held up there.
Okay.
But what's so strange, lastly, is that you offset it with the accounts payable. You're not collecting, but you're quick to pay whatever invoice comes through. And
so
many
it means you should sit on cash.
Multinationals do it a lot. I've been in positions whereby we inform clients. The CFO comes through and says, we're not paying anyone this month. What informs that decision? A cash forecast. Because he knows that the work he has done with government, for example, is not coming in this month. That 1 billion was expecting, or 10 million, is not coming in. So what do? You become proactive. It means don't pay all these suppliers that are not urgent. We're only paying taxes and payroll. Whoever comes, just tell them a story. But that's what we call working capital management.
Okay.
So yes.
And then monthly, what am I doing monthly?
Monthly, good question. SMEs are poor at looking at their management accounts on a monthly basis. They only look at their accounts at the end of the year.
This data, by the way, is pulled from like my accounting system, like whatever software I'm using.
So, too many questions. So as you scale as a business, right? In other words, you're getting more customers, more SKUs, stock keeping units coming through. There's more demand, more inventory. How do you keep track of all this in Excel? Excel can crash. Excel is prone to errors. You have to acquire an accounting system that works for you. We have Xero. Xero has done quite well. QuickBooks, Sage, Zoho, and those are times free. The rest of these other packages just pay a small amount. But it's a penny wise, pound foolish. Just safer bringing in that equipment now, that accounting package now, using it right now, than rather than later. So, or if you can afford it, get an accountant to produce these management accounts on a monthly basis. But I know many SMEs that are scaling have accountants. The mistake they do on a monthly basis is not to review the management accounts sent to them. And that's where we guys come in as fractional CFOs, saying, okay, we'll give you 1 hour of your time. Let's go through these management accounts
and help you
understand your performance in this particular month. Why? It will fix identify the leakages, fix them, control your margins, control your cash, and that's how you scale.
So basically, as we're looking at these sort of management accounts, like what is it that I'm looking for exactly? Am I looking for my GP? Am I looking for, am I looking at my balance sheet? Or is it just, expenses and income? Like what am I looking?
Management accounts are made up of 3 key financial statements. You have your P&L. That's your profit and also income statement. So all that does, it's like a scorecard. It's keeping track of your revenue, your costs, and your profit, and maybe your taxes paid. That gives you your net profit. Right. You have your balance sheet, which is a snapshot of your assets and liabilities at a particular time T. Right. Then you have your cash flow statement, which is the lifeblood of every organization. Without cash, you're unable to meet your short-term or long-term obligations. You're not very attractive. You won't last long in the market. So those 3 documents are so important. You have to review them on a monthly basis and take corrective action now rather than at the end of the year.
What should give me palpitation? Like if I'm tracking, say for example, any of the 3 statements, what should really cause me anxiety?
So 1.
When what happens?
Revenue, it's important. I encourage SMEs also to start budgeting, because that helps you track your performance on a monthly basis, because you have your actuals coming in, revenue, costs. How do you know you're performing well? You have to base that either on a forecast or on a budget. That variance is what you then provide a commentary on and take corrective action on. So how do you know you're performing well this year? When it comes to personal goals, you look at the target set in January. I want to go to the gym 4 times a month. It's July. How do you know how you're faring if you didn't set a target? So that's important. So you panic if the variance is high. It's above 10%, 20%. There's something wrong. Your cost structure, because your gross margins have fallen. What happened? What were the drivers? Am I pricing right? Is there a competitor that has come through that is eating up on my market share? My cost structure, is it too heavy? Right? Then you begin to tweak, right? To maintain your margin. So either you begin to subcontract. If you had people seated on the premises, you're not sweating those assets that much, you're not utilizing them, maybe get rid of them and maybe adopt a subcontracting model. So it allows you to take decisions on a timely basis to correct the leakages.
Okay.
Because remember, you're in business to make money,
Yeah.
right? So if you find out that you are losing money along the way, what do? You take corrective action. But something needs to guide you, and that's where the management accounts come into play. The actuals, the forecast, the budgets. You look at that variance to track how you're performing.
Yeah.
Then of course you look at your revenue, gross profit, right? Because gross profit is a key element of identifying your financial health. Then you look at your net profit. Okay, after your overheads, what am I seated at? Great. Okay, quickly look at your balance sheet. How am I performing? What's my cash position like? Who owes me money? What's happening there?
Okay.
Right?
Yeah. And
My
when should
assets and the
when
like.
should I be happy? Okay, you know what? I'm in a comfortable position.
Right.
Is it not just,
So-
I suppose, the opposite of.
I would say if you're breaking even,
Yeah.
it's a good start for an SME. Total revenue equals total cost. You can cover your fixed overheads.
Yeah.
That's a comfortable position. Anything above that is a plus. Yeah, because that means you're onto something.
Do you often see people breaking even? I mean, I know you work with different SMEs.
So I'll give you a particular example whereby I have a client whereby she was not reviewing her management accounts. She has not invested in a financial personnel. She has someone producing the accounts, but she has not been looking at the accounts.
Yeah.
I'll give you a very practical example. She wins this massive contract with one of the mining companies.
Yeah.
There's what we call revenue recognition. Revenue recognition, it's important. There are steps that you follow before you recognize revenue, right? So in January, she received a call from the client saying, send me an invoice. It was a misleading comment, but send me an invoice. I want to ensure that I know I owe you money, but I want to ensure that I raise a PO so that it's encumbered against the budget, because my year end is February. I don't want to lose out on this budget. But remember, the work hasn't been done. So what does she do? She raises the invoice, system invoice. So the revenue gets recognized in January, but the work is going to only happen in March,
And
in a
that's
new
what she
financial
paid.
year.
And then VAT.
The VAT, that also triggers that leg, the VAT component. Because remember, SARS says it's not your money, you're collecting it on behalf of
Yeah.
SARS. So that VAT becomes due.
End of Feb.
End of Feb, but remember that work has not been done. So she begins the year owing SARS. She begins the year on a loss, because remember, all the costs are coming in now in March, but she recognized the revenue in Feb. So you find yourself starting off the year in a loss position because of you not understanding how to interpret financials. So I encourage SMEs, founders, to invest in accounting services. But over and above that, once you receive those reports, review them, find the time to study them. If you can't study them, seek. It could cost you 1,000, 2,000 rand an hour to have those financials reviewed with yourself.
Yeah.
Look at it as an investment in yourself, because eventually you're going to scale. Remember, you're going to scale. You're a small business now, but if you don't have those processes in place, 5 years down the line, you still need the services of an accountant, of a financial person. So all you're doing right now is to bring them on board right now, so that you have practices, processes that are conducive for your business.
Okay.
Yeah.
I know that we've spoken about this, but I do want us to emphasize it. So I have a dashboard, right? As an entrepreneur, I know that, you know what, if somebody asks me this question any given time, I will have an answer for them. Like, what are those, let's say, five key things? Yeah.
How are you tracking on revenue or sales? You should know that number, right? Another thing, what's your break-even revenue or break-even units? Why? At any one time, you want to know that I'm comfortable, that I'm on track, knowing that I'll cover my fixed overheads. because those are not going away. At the end of the month, you have to settle them.
Yeah.
On a monthly basis, cash position. What's my cash balance right now? My debtor days. I have to have a credit meeting. Corporates do it quite well. Credit meetings on a weekly basis or bi-weekly or twice a month, where you review who owes you what and which buckets are those figures in. Is it 90 days? What course of action do I need to take? Because cash flow is everything. So that's another one you look at. Depending on the sector you're in, if in FMCG, inventory at all times, you don't want to be out of stock because your customer will be disgruntled and move elsewhere, right? So you have to know the inventory on hand at any one time. How are we tracking on that? So it's your revenue. The cost structure will come in later because costs come in over time. So you only review that on a monthly basis. But you track on a weekly basis. You look at cash flow, your revenue or sales. How are you tracking on your sales? Your cash position. I already mentioned that. But your debtors position. How is money coming in? Your inventory position. Those are some of the areas I would really stress. The tax obligation always kicks in on the 15th or the 16th of every month.
So this is that pay as you earn?
Pay as you earn.
Okay.
CIPC.
Okay. That's usually annually with CIPC.
Yeah, annually. That's annually, but those are some of the taxes you have to be aware of. So you have to have a tax schedule. Okay. But that your accountant will prepare. Right. Will prepare for you.
And what should I sort of, if I hire an accountant, what should I expect from them on a monthly basis? Because sometimes when you think, I don't have the experience, and then sometimes you don't have the confidence and you don't know what you should require for them, sort of key KPIs that you should you should have in place.
If I hire an accountant, I will expect him, let's start on a weekly basis. Tell me how we are performing in terms of your revenue, where are we? First of all, I expect him to give me some commentary of last month's position. How did we perform the previous month? Yeah. Where were the pitfalls? Where are the loopholes? What are we going to do about them to correct them? Yeah. But as an accountant, I consider you to be a business partner. So you're not only an accountant, you're a finance business partner. So you work with every department. So to extract as much value, usually when accountants on board or come on, they want to understand the business holistically, because that's where their true value is. Yeah. They'll be working with operations, they'll be working in the warehouse, understanding what's happening there, inventory, the production lines, how are things going, working with the brand managers, marketing, sales, and then procurement, right? Because invoices will be coming through. Do I need to pay, not pay? But I need also to be chasing up on what we have sold. Are those invoices coming through? So as an accountant, on a weekly basis, you should be following up with departments to see whether everything is running well. But every week, I would expect you to, once you help me track on the revenue, help me track on the cash flow exposures, if any. What other exposures do we have? Do you have any tax exposures? What risks are inherent within the business? I need you to identify those for me, because you're my eyes and ears from a financial perspective, right? Because that's important. But also, help me draft policies and procedures. Help me put in place processes, right? Because those processes, as a founder, what are we trying to do? Break the founder syndrome of everything being done by you. Yeah. You founders are reluctant to relinquish work. You're reluctant to delegate. Yeah. But in so doing, you're affecting your mental health. You're slowing down the process. It's going to affect your scaling. You're going to drop the ball along the way. Yeah. So when I come on board, I'm here to help you. I'm your eyes and ears. Can we work together? So I'll put in place those internal controls. I'll put in place those policies and procedures, right? Yeah. Help you put in place even governance controls. Ask the right questions. Do we have an advisory board? Do we have who's I can help you we can get a few people to come on board because we don't have to even pay those advisory people.
And I know, Martin, you've put
Right.
together such a beautiful checklist.
Yeah.
And I'd love for some of our founders to, if you're keen on to get this checklist from Martin, you can comment.
Yeah.
Just say finance, and then we'll just email you from Fractional CFO.
Yeah.
Just in terms of what you should look out for, whether it's monthly, it's weekly, it's annually, and what should be in place, especially if you're going to even go raise money either from a bank or from a development finance, even from an investor. So please do comment finance, and then we will send you that with Martin, and just so that you have that, and then you can always use that at the back of what you use as a checklist. I mean, even using it to guide with what your accountants can produce for you and what they should have for you.
Absolutely. So
thanks for putting that together.
So as an accountant, you always have that monthly checklist so that you don't miss anything.
Yeah.
But over and above that, we have created as a company, Corton Advisory, we have set up a due diligence checklist that helps SMEs if they are looking for funding. What are the documents you need to have in place from a governance perspective? Finance and operations, strategy, human resource, and. We have a detailed checklist, which I'll gladly share with interested parties.
No, awesome. Thanks, Martin. I know this is just probably it's quite cheeky of me to ask, but is there like a margin that any business, especially in FMCG, we should be comfortable with?
Yeah.
Just like a percentage.
What margin? First of all, there's what we call industry benchmarks. This information is readily available. You can go and see what other competitors are doing. You can, in FMCGs, I think there's a Nielsen that has this database or a collection of information. But to answer your question, an acceptable margin is can be determined by yourself, right? But again, it depends on the kind of products you're selling, the competition out there. So it's a very hard question because it varies from sector to sector, company to company. There are instances where an acceptable margin for a product that is complementary could be loss-making. Why? It's complementary. In other words, you have to sell it with another product because we have the cash cow. This product generates the most revenue, but in order for us to boost the sales of this, we need to add another product on it, create this value pack, right? So we could argue that we will take losses or a reduced margin on this particular product in order to promote this other product.
Yeah.
So it depends what management sees as an acceptable margin. It varies from sector to sector. It varies from product to product, right? Because you will find that, I'll give an example of a company I worked with in home care, right? They found out that their health division performed better. It had better margins. And they found out that maybe we need to start getting rid of the home care divisions and focus on these key products. And that's what we call product or portfolio optimization, where you go back and look at your business holistically and understand, okay, there's some products that we'll have to carry along because they boost this other product. And we accept that their margins are XYZ.
Yeah.
But also mostly it's driven by the kind of product, the competition. If you have, of course, an aggressive market, the margins are likely to be less. If you're selling unique products like a Bentley, of course, just sell one, the margins are higher. Those are premium products, right? So of course, the margins are going to be different when it comes to that, assuming that their cost structure is also minimal and that they can sell at whatever price they would like. But remember also the likes of Bentley also compete with the likes of Ferrari and all these other people. So they have to be cognizant of that. So what's the acceptable margin? It depends. It depends what sector, what product, what's the market dynamics you're playing in. So there's a lot you have to factor in.
Martin, this is just so rich. They're so insightful, and just thank you so just for sharing with us, sharing with our community in terms of how do we build specifically around finance. I know this has been something that was intimidating for me in the beginning because I don't come from finance in terms of, I'm not a CA, but I was passionate about building a brand, and so often it brought a lot of intimidation and a lot of nervousness, and I felt so so incapacitated, you know, and I didn't have confidence around that. And helping and having people to walk alongside who actually walk with you as a partner to help you unpack and understand. So thank you so much for just freely giving this information. Thank you so much for tuning in. And as I said, to get a great sort of key indicators, what you should look for, but also what Martin has put together in terms of a checklist, please do comment finance and we'll send that through to you. But thank you so much for joining us, and happy building, and make sure you're tracking the right things. Stay tuned for the next video.